Okay, budget and budgetary control. Cash budget. Question number 5. From the following information, from the information given below, sales are both on credit and for cash, the latter being 1/3 of the former. That means if credit sales is 75%, cash sale is 25%. Okay, so later is 25, means if it is 25, credit sale is 75, means 3 times of the cash sale. Then realization from debtors are 25% in the month of sale, 60% in the month following that, and balance in month after that. Means this credit sale which we saw in point A, that credit sale is nothing but the debtor. We are going to realize 25% in this month of sale itself, then 60% in next month, then balance means 15% in next to next month. Okay, the company adopts a uniform pricing policy of the selling price being 25% over cost. Okay, so this point will be used for determining the purchase. The company adopts uniform pricing policy of the selling price being 25% over cost. So whatever sales are there, if we remove 25% of that, we will get the purchases. So budgeted sales of each month are purchased and paid for in the preceding month. In the sense, if it is for February, it is already paid in January. The company has outstanding debenture of 2 lakh on 1st January, which carry interest at 15% per annum, payable on the last date of each quarter on calendar year basis. 20% of the debentures are due for redemption on 30th June 2014. Okay, very simple point. 2 lakh worth of debentures are outstanding, on which 15% interest payable, which is quarterly payment, and 20% of the debenture means 2 lakh is there. 20% of the 2 lakh is due for redemption on 30th June. Then the company has to pay the last installment of advance tax for assessment year 14-15, amounting to 54,000. So that will be paid in March, because last installment of advance tax is paid in March. The anticipated office cost for the 6-month period are Jan to June. They have given respective cost. The opening cash balance of 10,000 is the minimum cash balance to be maintained. Then deficits have to be met by borrowings in multiples of 10,000, on which interest on monthly basis has to be paid on the first date of the subsequent month at 12% per annum. Okay, means minimum cash balance requirement is 10,000, and if it is going below 10,000, we have to borrow at the rate of 12%, and interest on that borrowing will be paid next month. Rent payable is 2,000 per month. Sales forecast for the different months are October to July. They are given respective sales. Then prepare a cash budget of Excel Limited for the first half of 2014, means January, February, March, April, May, June. January to June. Year of assuming prepare a cash budget of Excel Limited for the first half year of 2014. Year of assuming that costs would remain unchanged. Okay, so now we'll start cash budget. Very simple. What we have to do, we have to prepare cash budget for January to June. So that's why it's made particulars: January, February, March, April, May, June. Okay, opening cash balance they have given 10,000. So you'll start with 10,000. Okay, we'll start with 10,000, but before that we have to keep this ready, because there is a requirement of minimum cash balance 10,000. If there is deficit, we have to borrow. So simultaneously we'll keep doing this computation on deficit to be met by borrowing. So 10,000 opening balance. So what we have to do? Second important thing is that we should know the receipt from sundry debtors. Some calculation we have to do. How we have to do? They have given in the question clearly that sales are both on credit and for cash, the latter being 1/3 of the former. So credit is 75%, cash is 25%. So see, realization from debtors are 25% in the month of sale, 60% in following month, and 60% in month following that, and the balance in the month after that. So see, 25% in the same month, 60% in next month, 15% in third month. This credit sale they have taken from November onwards. See, November onwards again. Why we have taken from November onwards? Because November month sale 25% in November month itself, then 60% of November month sale in December, then 15% in January, and from January is relevant for us. That's why from November we will take, because the 15% of the November is coming in January. Okay, that's why from November it is taken. November, December, January, February, March, April, May, June. Till June we have to make it. So first of all, what we have to do? First of all, just take the 75% of the sales from November to June. From where is that? November to June, because that only is credit sale. And out of that, how much is required? See, 1,35,000 is there, no? In that 25% the same month. 25% in same month, not relevant. Then 60% in next month, December, not relevant. One second. Okay. Then 15% is the next to next month, means third month. So that is relevant. So that's what they have taken here. 15% in the third month, 20,250. Yes, going from down to up. So 15% of November came here, then 60% of December came here, then 25% of January came here. Like that we will do for everything. You'll find out the cash receipt from debtors for respective months from January to June. Okay, then now what we have to do? Now we have to start doing this cash budget. So opening balance 10,000 is there. Cash sale was 25%. This point number A, 25% of the sales of the current month. So January is there, 2,20,000. Of the 25% means 1/4 is 55,000. Likewise for every month, 25% is cash sale. That's what taken just like that for all the month. Then from debtors, whatever we calculated here, we'll take it just like that here. Okay, we'll take it here. Then one row leave for borrowing. If any borrowing is there, that time we'll see. Okay, one row just leave for borrowing. Then that's it. Anything else we are receiving? Nothing else we are receiving. Okay, one cash sale was there, one realization from debtor was there, and that's all. That's it. So now that's it. 10,000 opening balance, cash sale from debtor 1,51,500. So total cash available is 2,16,500. Okay, then purchases. This point is there, no? Point number C, the company adopts uniform pricing policy of selling price being 25% over cost. That is one point. This point. In point D, budgeted sales of each month are purchased and paid for in the preceding month. So for example, from Jan to June we are seeing. So February month is paid in Jan. That's what they are saying. Preceding month it is being paid. So 1,40,000, which is sales, and which is 25% over cost. So what we have to do? We have to bring down that sale. We have to remove that profit element. That's why it will be called as cost purchase. Okay. So what we have to do? 1,40,000 divided by 125%. You will get. Okay, you will get 1,12,000. So just like that, March received in Feb. So whatever amount is there in March, 1,60,000 divided by 1,25%. Okay, just like that. April in March, May in April, June in May, then July in June. Okay, like that we will find out the purchases. Then office expenses are given just like that. Here office expenses, point G, 25, 20, 40, 35, 30, 45. Okay, we'll just write down here. Okay, whichever we're getting, we'll just write down here. The purchase we got, we'll write down here. Then office expense we got, we'll write down here. Then see, next point is office expense is done. The rent payable 2,000. 2,000 we will write down here for every point. Okay. Anything else is there? Nothing is there. So what we will do? This is the total payments. Purchases, office expenses, rent. Total 1,39,000. Total cash available is 2,16,500. Payment is 1,39,000. Opening balance is closing balance is 77,500. Okay. Here also we'll keep updating. Opening was 10,000. Okay. Receipt was 1,51,500 and 55,000. That was the receipt. So that is 2,06,500. Total cash available is 2,16,500 and payment is 1,39,000. So balance is 77,500. So there is no need to borrow because it is more than 10,000. So closing balance 77,500. It will go to next month. Just like that. Next month's receipt is 35,000 plus 1,47,750. Okay. So that is coming around 182,750. So if you add that with opening balance, total cash available is 2,60,250. And then payment is 1,50,000. 1,50,000 if you reduce, the balance is 1,10,250. That is closing balance. It will go to the opening balance. So next month. Okay, then again we will do a receipt of the month is 40,000 plus 1,17,750, which is 1,57,750. If we add with 1,10,250, total comes to 2,68,000 and payment is 2,23,500. In this one, March month they have said something. No, March month you have to be careful because March month they said quarterly payment you have to make for this debenture interest. So 2 lakh into 15% will come around 30,000. So 30,000 into 3 divided by 12 because for quarter only you have to make one. So that is coming around 7,500. And this last installment advance tax 54,000. So that's why that's 7,500 and advance tax 54,000 has come here. So total payment. So 2,23,500 if you pay. Balance remaining 44,500. Again not required to borrow. 44,500 will go to next month. 44,500. Okay. Again receipt is 37,500. 1,15,875. Okay, just do you see 37,500 and 1,15,875. That is coming around. Okay, 153,375. 153,375. Okay, so if you total with 44,500 opening balance, you will get 1,97,875 and payable is 1,97,000. So if we deduct that, you will get balance 875. But our requirement is 10,000 minimum cash balance. So 10,000 we have to borrow. 10,000 borrow because in multiples of 10,000 only we can borrow. So 10,000 borrowed. Now closing balance 10,875. that will be opening of next month. 10,000 borrowed, no, that 10,000 only taken here. Okay. The next one, May 10,875 opening balance. Then receipt for the month is 50,000 and 1,23,000. So that is 1,73,000. And total cash payable is, total cash payable will be 1,44,000, 30,000, 2,000. This we already calculated earlier. And this 100 came, this 10,000 is there. On that 12% per annum interest is there. So for 1 month, 1%, 100 rupees. So that's why 1,76,100. So 1,76,100 if you deduct from 183 is 875, you will get 775, which is less than our minimum requirement of 10,000. So that's why we will borrow again 10,000. So closing balance 17,775. Okay, so we borrowed here, no, we will mention here borrowing 10,000. Okay, then next month closing balance will become opening balance 17,775. Then cash sale again, cash sale and credit sale utilization 185,625. Total availability to 3,400. Payment is 1,90,700. How? All these things already calculated. That 7,500 will come. The interest payment because it is quarterly. So 7,500. That's why came again. This is 200 because 10,000 plus 10,000, 20,000 into 1%. So 200. Okay, and also this debenture was about to redeem. 20% of the debenture was due for redemption in June. So 20% is 40,000. So that's a 40,000 redemption or debenture. We'll remove that. So total payment is 1,90,700. Okay. If we deduct that, we will get balance 12,700, which is well above the requirement of 10,000. So no need to borrow in this month. So that's 12,700. That's it. End of this question. Okay, question number 6. Shri Ganesh has given the sales forecast for January to July 2014 and actual sales for November, December with the following particulars. Okay, so sales is given November to July. Then what they're saying, sales is 20% is cash, 80% is credit payable in third month. Okay, means if January sale is there, that is payable in March. Then variable expenses 5% turnover. Time lag is half month. Half month means half paid in the current month itself, half is paid in next month. Then commission 5% on credit sales payable in the third month. Then purchases 60% of the sales of the third month. Okay, 60% of the sales of the third month. Then payment is third month of purchases. Say 60% of the sales of the third month and payment is third month of purchases. For example, November is a November. In November we have to purchase for January month sale, and when we will make the payment in January only, because payment also we have to make, because if November we purchase, we are going to make the payment in January, and in January if we are selling, we are purchasing in November. So ultimately it looks like for January month sale, 60%, out of the January month sale, 60% is the purchase which is paid in that month. Okay, then rent and other expenses 3,000 paid every month. Then other payments, fixed asset purchased March 50,000. Then taxes paid in April 20,000. Opening cash balance 25,000. Required to prepare cash budget for the 5 months, January to May. So first what we'll do, we'll just find out the cash and credit sales. So since it's saying payable in third month, so what you have to do, we will take from November, because November will also be paid in third month. November will be paid in third month. November, December, January. Okay, like that. So see, November to May, because up to May only we are, so we have to make the budget. First total sales is taken. First total sale is taken. 80, 70, 80, 180, 190. Okay, 80, 70, 80, 100, 80, 100, 90. Total sale is taken. In that 20% cash sale, 80% credit sale. And what they said, credit payable in the third month. So November payable in the January. So see, realization from debtors. This 64,000 payable in January. 50,000 of December payable in Feb. This 64,000 in Jan payable in March. Okay, likewise we will do this realization from debtor. Okay, we got the debtors. Okay, realization from debtor, and we are already having cash sales of that particular month. So sales we got. Now first let's finish off the working out, then we'll get into this main table. Then variable expenses, 5% of turnover, time like half month. So what we will do, we can make from December itself, but here I think they have made from November. No problem, why to unnecessarily write from November, but you can even make on December itself. The variable expenses, number in January till May. What it is saying, payment half of previous month, so half of December, half of 3,500, 1,750, then half of current month, means half of 4,000. Okay, that is the total payment of the current month. So like that you will calculate for everything. We will get to variable expenses. Okay, variable expenses we got. Then 5% of credit sale payable in the third month. Here we will take from November, because payable in the third month is there, no? So commission November to May. What it is saying, 5% of credit sales, so only credit sale you have to take. Credit sale we calculated here, no? 64, 56, 64, 80, 64, 80, 72. Okay, so that's what we have taken here fully. Okay, you can match it up. 64, 64, 56, 56, 64, 64, 80, 80. Okay, you can match it up. And 5% of that, just calculate, like 5% of 64, 5% of 56, just calculate right there. And this in November, 5% is 5% of commission in November is payable in January. So likewise they have done. So 3,200 of November payable in January, 2,800 December payable in Feb. Like that you have to write down. Okay, so commission also we got. Now what we have to find out is purchase. 60% of sales of the third month is what I said. See, they have written also payment for purchase made for third month requirement. Okay, that is November purchase will be for January sales. In addition, payment is made in third month from the purchase, that is the payment for November purchase will be made in January. It means payment for purchase will be 60% of each month's sales. Okay, nothing very simple. What they are saying is purchase 60% of sales of third month. Just see November. Okay, November for January we are purchasing in November. Okay, for example, for January we are purchasing in November. Then next month what they are saying, payment third month of purchase. Okay, for January we are purchasing in November, but for January we are paying in January. Like For January we are purchasing in November, but for that purchase we are again paying in January only. So whatever sales are there in January, whatever sales shown in January, out of that 60% is paid in January. That's what they are saying here. See, payment for purchase made for the third month requirement, that is November purchase will be for January sales. In addition, payment is made in third month from the purchase, that is a payment for November purchase will be made in January. It means payment for purchase will be 60% of each month sale. That's what we'll do. January to May will take 60% of current month. Okay, that is the purchases. That's it. So we got everything. So now we will start making it. Opening balance they are given cash 25,000. Okay, so cash sale we found out here. This 16. Don't see this one. This because this one we have to say. Okay, 16,000. You can just like that. You can write down for every 16,000, 20,000, 16,000, 20, 18, 60, 20, 60, 20, 18. Okay, then collection of debtors also you can write down 64, 56, 64, 80, 64. Down. Don't write for cash opening balance because that will come from down only. Okay, now just come to this January column. Opening balance 25, cash sale, credit sale, total cash inflow 1,05,000, then payment to creditor this 48,000 will go out. Then variable expenses there is 3,750, then commission 3,200. That's it. From here what we could take is purchase, commission and variable expenses. Purchase so where is it? Purchase, variable expenses and commission. So what we will do, just write down purchase for every column 48, 60, 48, 60, 54. Okay, this all written down for all. Variable expenses written down for all. Commission written for all. Okay, that's it. So variable done, commission done, purchase done. Now come here, rent 3,000 for everyone. So that's why 3,000 taken for everyone. Then they purchase fixed asset, so 50,000 when they purchase March, so in March. Okay, then taxes paid in April 20,000. Anything else? Nothing is there. Just total down this, we'll get balance, we'll get closing balance. Okay, closing balance will be the opening of next month, just like that. Okay, if we do like that, that's it. Okay, one column you do add this inflow, add this outflow, deduct from inflow, deduct the outflow, you get closing balance. It will go to next month opening balance, like that, and that's it. The question will be done. Question number 7. You are given the following information. Estimated monthly sales are as follows. From January to October sales are given. Then wages and salaries are estimated to be payable as follows. So wages and salaries are given for month April to September respectively. Of the sales, 80% is on credit. Of the sales, 80% is on credit and 20% of cash, 20% for cash. 75% of the credit sales are collected within 1 month and the balance in 2 months. That means for example January sales is there, in that 80% is credit, and that out of 80% credit, 75% is collected in Feb and balance 25% in March. Okay, there are no bad debts losses. Then purchase amounts to 80% of sales and are made and paid for in the month preceding the sales. Preceding the sales means for Feb paid in for March paid in Feb, like that. Okay, the firm has taken a loan of 1,20,000 interest at 10% per annum has to be paid quarterly in January, April and so on. As quarterly it has to be paid. The firm is to make payment of tax of 5,000 in July 2014. The firm had a cash balance of 20,000 on 1st April 2014, which is the minimum desired level of cash balance. Any cash surplus or deficit above or below this level is made up by temporary investments or liquidation of temporary investment or temporary borrowings at the end of each month. Interest to be ignored. What is required is prepare monthly cash budgets for 6 months beginning from April 2014 on the basis of the above information. Okay, so we have to make the cash budget. Very simple question. What we have to do? First thing what we can do is just find out the realization from the debtors. So see, because first month credit sale is collected in next month 75%, then next month 25%. That's why for making budget from April to September we have to consider from Feb also, because some portion of Feb is being receivable. It's being received in March. It is being received in April also. So total sales. See this total sales from Feb onwards we have taken. See this one from Feb onwards we have taken 1,20,000, 140, 80, 60, 80, 1,80, 60 up to September. Because 6 months only we have to make, April, May, June, July, September. 6 months only we have to make. In that 80% is credit. So 80% of that is taken just like that. And this out of this, just see this Feb. Out of this 96, 75% received in March, 25% in April. Just like that, we'll keep on allocating like that. This 1,12,000, 75% in April, 25% in May. Like that we'll do for everything. Then we'll get the total collection from credit sales, from debtors. Okay, we'll get the total collection. That's it. We got that. Now we can get into preparing the budget. So April to September we have to make opening cash balance. How much they said? 20,000. Okay, that's what 20,000. So cash balance, cash sales they are saying 20% is for cash. So April to September whatever cash is given, so whatever sales is there given, in that 20% is cash sales. So just like that we will take, so 80,000 into 20%, 16,000. Okay, like that for everything we'll take. Cash sales taken. Opening balance 20,000 is taken. Collection from debtor we'll take on this working note. Just that we'll take everything. Okay, so anything else than that is receivable, nothing is there. Okay, see, nothing is there, right? Sales was given, wages also payable. This is credit sale, we did that. Purchases, it is also outflow. Interest also outflow. Firm interest also outflow. That's it. Okay, so cash sales, credits and opening balance total 1,44,000. Then payment. First is wages. Okay, first let's find out the purchases. What they say, purchase amount 80% of sales and are made and paid for in the month preceding the sales. For example, from April we are taking, so from April we are making the budget. So it is see May for April payment. So 60,000 into 80%. Because 80% of sales are made and paid in the month preceding the sales. So 80% of 60,000 is how much? 48,000. So 48,000 of say purchases. Like that we will do for all the months. Okay, May for April, June for May, July for June. So just check in June it should be 80,000. Okay, just like that we'll find out the purchase. Then wages and salary will just like that we'll copy and paste from here. 9, 8, 10, 10, 9, 9, 9, 8, 10, 10, 9, 9. Okay, we'll just like that do it. Then interest on loan, purchase is taken, wages is taken, then interest on the 20,000 into 10%. Quarterly it is, no, so 3 by 12, so 3,000. Sorry, 3,000 in April and in July. Then tax payment they are saying 5,000 in July, so 5,000 done here. So almost we have written cash sales, we have written collection from debtors. Okay, we got purchases fully, we got wages and salary, interest and loan, tax payment we got. Now we will start doing one column. Opening balance sheet was given here. Now just total receipt, total payment is how much? 48,000, 9,000 and 3,000. Total payment is 6,000. Minimum cash balance required is 20,000. So total cash required is 80,000. So this total cash required minus total receipt available. In that we are getting surplus of 64,000. What we will do? We will invest, because we are having surplus. We will invest. So closing cash balance is 20,000, which will be opening of next month. Okay. Then again total of received and total of payments with minimum cash balance. So total cash required 92,000. Okay, and how much we are having received? 1,08,000. So we are having excess surplus is 16,000. We will invest. So closing cash balance is okay. So 20,000 opening of next month. Then again add cash sales, collection from debtors, you'll get total receipt. Then remove this total payments including minimum cash balance. So whatever is excess there, see here we are having shortage. If it is shortage, we have to get it finance. Okay, so 20,000 we have to borrow actually. So 20,000 again we have to maintain the cash balance in anyhow. So 20,000 taken next month. Just like that we'll do for all the month. We'll get the answer. Okay, that's it. Then cash budget in question number 8. Cash budget in budgeted income statement. On 30th September 2013, the balance sheet of Danish Sugar and Company, retailers of sugar, was as under. Liabilities given 20,000, reserve and surplus 10,000, trade creditors 40,000, audit fees 15,000, equipment cost 20,000, less depreciation 5,000, so 15,000 WW. Then stock is 20,000, trade debtors 15,000, balance at bank 35,000. That firm is developing a system of forwarding. The firm is developing a system of forward planning, and on 1st October 2013 it supplies the following information. Okay, month is given, credit sale is given, cash sale is given, credit purchase is given. Okay, this data is as on the 1st October 2013. Okay, all trade data are allowed 1 month's credit and are expected to settle promptly. So see, this credit sale is there, no, nothing but the debtor balance. Okay, so it is as on 1st October. So what they are saying, 1 month credit and are expected to settle promptly, means by the end of 31st October we might have received it. Okay, but all trade creditors means credit purchases are paid in the month following delivery. Okay, means for September payment is in October, for October payment is in November, like that. Okay. Then on 1st October 2013, all the equipment was replaced at a cost of 30,000. Okay. What we have done, we have purchased a new equipment. This equipment is there, no? This equipment whose WW is 15,000 now. Okay, we have purchased a new equipment costing 30,000 and 14,000 was allowed in exchange for the old equipment. Okay, and a net payment of 16,000 was made. So what it is saying, we purchased new equipment for 30,000 and this one was given as exchange, and for exchanging this old equipment we got 14,000 as cash back. With ultimately cash went out of hand is how much? 16,000 only. Net cash 16,000 went out. Okay, and depreciation is to be provided at the rate of 10% per annum. Then audit fee will be paid in December 2013. Audit fee is there, no? Will be paid in December 2013. Okay, then the following expenses will be paid. Wage is 3,000 per month. Administration is 1,500 per month. Rent is 3,600 for the year to 30 December to be paid in October 2013. Okay, then the gross profit percentage on sale is estimated at 25%. Okay, required is cash budget for the month of October, November and December, and we have to prepare income statement for 3 months ending 31st December 2013. So see, first let's find out the cash realized and total cash sales, including cash realization from the debtors and also the cash payment for credit purchases. Okay, so see the working out statement showing cash and cash credit. So credit sale they have given, see, October, November, December only we are making now. So October, November, December, credit sale 18, 20, 25 taken, cash sale 5, 6, 8 is taken. 18, 20, 25, 5, 6, 8. Why that is taken? Because this figure is as on 1st October and 1 month credit is given. So obviously by the end of month it was settled promptly. So it was October was received in October itself. Okay, that's why it was taken like this: 18, 20, 25, 5, 6, 8. So total sales we got for October, November and December. That's it. So total sales is 82,000. Now they are saying gross profit on sale is 25%. 25% gross profit on sale, that is coming 20,500. So if you reduce from sales, if you reduce gross profit, you will get cost of goods sold. So cost of goods sold is 61,500. Okay, that's it, 61,500. Now balancing will come later. Now we will make the cash budget first. So opening balance is given how much? 35,000 here. 35,000 is there, and sales, credit and cash. Credit is how much? So 1 second, sorry, it is like 1 month credit is given, no, so interpretation was wrong. 1 month credit is given, so September will be received in October in November and December. Okay, so that's why credit is taken like this: 15, 18 and 20, 15, 18 and 20, and cash will be 5, 6, 8. Okay, so total received, just take C for October, 35 plus 15 plus 5, it is 55,000. Then credit will be like that only, 40,000 paid next month, no? So that 40,000. Then purchase also taken. Then we have to see uh, this equipment we got, no, how much net cash went? 16,000. So that's 16,000. Then wages, 3,000 per month. 3,000 per month means for 3 months we are making, no, okay, 3,000 per month, so 3,000, 3,000, 3,000 every month. Okay, so that's what taken, 3,000, 3,000, 3,000. Okay, the admin 1,500 per month, so 1,500, 1,500, 1,500. This audit fees payable, no, how much? 15,000. So audit fees taken 15,000. Now admin also we taken, wages also taken, rent 3,600 for the year to 30 December, to be paid in October. So 3,600 is paid in October, so that 3,600 taken here. Okay, so that's it, I guess. Yeah, that's it taken. So total payment came 64,100. Direct from 55,000 you'll get cash. Closing balances overdraft carried forward to next month. Then again receipt is a 23,000 only, and payable is 27,000. Again overdraft carried forward to next month. The receipt is 27,000 only, payable is 46,500. Again overdraft of 31,100. So first one is done. Now we have to make the income statement for the 3 months ending 31st December. So let's start making sales. The sales we have to take, because when you are making income statement, there we have to take the cash as well as credit sale, both we have to consider for that month alone. That's why it is taken like this: October, November, December. So 82,000 is the total sales. So 82,000 taken. Cost of goods sold. Cost of goods sold is nothing but sales minus gross profit. So gross profit, to find out 25% of sales, that is 20,500. If you reduce gross profit from sales, you'll get cost of goods sold. So that is coming 61,500. But the 61,500 includes cost of that whatever goods you are selling. That in that material cost is also included, wages cost is also included. So wages cost, if you reduce, you will get cost of material consumed. So 61,500. How much is wages? 3,000 per month. So for 3 months 9,000. So 61,500 minus 9,000, 52,500 is the material consumed. Then closing stock is also required. So opening stock plus purchases minus material consumed. Opening stock how much? 20,000 given here. So opening stock plus purchases. See, obviously opening whatever is there plus how much you are going to purchase plus how minus, if you reduce from that how much you have consumed, the remaining thing will be closing stock only. So that's why opening stock plus purchases minus material consumed is closing stock, 43,500. So see, material you can do in this way also, opening plus purchases minus closing material consumed, or you can take from here directly material consumed, 52,500. Okay, then okay, so cost of goods sold is material taken 52,500, which is taken 9,000, total 61,500. So sales minus cost of goods sold, you will get gross profit 20,500. Then after you have to reduce other expenses. See, admin is there 1,500. So 1,500 into 3, 4,500. Then rent 3,600 for the year. That is given for the year, but we have to take for the 3 months only. So 3,600 divided by 12, that is coming 300. So for 3 months, 300 into 3, 900. Okay, 900 taken. So wages is considered, admin is considered, rent is considered. Now what is left is depreciation on this equipment. So 30,000 into 10%, how much? 3,000. So 3,000 divided by 12 into 3, 750. So that's what is taken here, 750. Okay, and we have received 14,000 in exchange of this 15,000 worth of machinery. So there 1,000 loss was there, no? So that 1,000 loss on sale of old machine, 1,000. Okay, so that will reduce, we'll get net profit of 13,350. That's it.